Hello, friends. Good morning. Listen, trying to understand financial statements without understanding the three most important principles that underlie all accounting is like trying to eat healthy without understanding what foods do in the body. There are three bedrock principles that govern all accounting. The first is the matching principle. The second is conservatism, and the third is consistency. The matching principle says record revenues on the dates they are earned, not when they are received, and record expenses on the dates they are incurred, not paid. This is the accrual basis of accounting. It's distinctly different than recording revenues when you receive them and the expenses when you pay them, which is known as the cash basis of accounting. The conservatism principle aims to make the books conservative so that those who rely on them, such as banks and investors, are basing their decisions on the most conservative view of your business. Otherwise, the results could be overly optimistic and aggressive and mislead those users. To make financials conservative, where doubt exists as to whether events have rendered damage to an asset, such as a customer not paying their invoice, or created a potential liability such as might arise from pending litigation, accountants estimate such potential losses and record them. For example, when a receivable from a customer ages due to non-payment, it casts doubt as to whether that customer will ever pay. When that doubt creeps in, it is appropriate to record an allowance for doubtful accounts, which increases an expense called bad debt expense and decreases the accounts receivable asset. That makes accounts receivable more conservative on the balance sheet. If an electric utility sparks a wildfire due to negligence in maintaining its equipment and people die, it is highly likely that it will be sued and pay out a claim someday, or claims. It would be conservative, therefore, for them to record an expense today with a corresponding liability called claims payable today rather than in the future. If such claims never materialize and there is no eventual liability, the liability they recorded today could be reversed in the future with a corresponding increase to income and a decrease to that liability. Now, users of financial statements rely on applying these two principles on a consistent basis so that financial statements are comparable year to year for any company and also comparable when comparing one company to another. This concept of consistency is paramount. Imagine if a company changed its accounting practices year to year. Their financial statements would be misleading and unreliable, and lenders and investors and management would be powerless to discern trends that are so vital when understanding the health of a company. I hope things make more sense now that you know how the matching principle, conservatism, and consistency influence your books and the work your accountant does. If you like this video, please share it and like it on this site. This is Robert Band, your business finance expert, helping business owners make their financial problems go away. Remember, one tip could be worth millions, and profits today become fortunes tomorrow, so don't let them fall through the cracks.